Now, when you trade with Alvexo, you are trading CFDs. CFDs are the fastest growing, largest investment vehicle in Europe and Asia. CFDs are derivative contracts. They're a financial instrument overseen by the regulators. They are standardized. So our contract at Alvexo is going to be no different than the contract offered at our competitors or from somebody in Asia. All the contracts are standardized. They all reflect the actual market price of the asset. So in other words, if your contract's for gold and gold is trading at 1450 and gold goes to 1500, so does your contract. The only difference is you don't own the underlying asset. And this has several advantages to you. And this is important to understand when we talk about trading. Is one of the biggest advantages, you can go long or go short. In other words, going long is pretty easy to understand. X, Y, and Z company is trading at $100, and you buy 10 shares for $1,000, and X, Y, and Z goes up to $125, and you sell those 10 shares, you made $25 per share and $250. Easy concept. Now, every contract requires you to take two actions and to complete two things. You have to open your contract and close your contract. You also must buy and you must sell, but nobody cares in which order you do the buy and the sell. Okay. And so in other words, in the first example, you bought X, Y, and Z to open your contract. So in order to close your contract, you have to sell X, Y, and Z. But you can also, if you thought X, Y, and Z shares were going to go down today and they were trading at $100, you could sell to open your contract. And you sold 100 shares of X, Y, and Z, and X, Y, and Z dropped from $100 to $75, what do you have to do to close your contract? You have to buy X, Y, and Z. So you'd buy X, Y, and Z at $75. You sold them at $100. You made the $25 profit per share. Now, to be honest with you, you would have invested $1,000 to make $250, and barely does a share, move $25 in one day. And especially when you're trading Forex, which trades in pips, which is 4 decimals to the right, you need to have a lot of shares or currency to make the trade worthwhile. Otherwise, you're taking risk for very little profit. And this allows you to, or CFDs allow you to use leverage. Okay. Leverage allows you to ramp up your trade. But don't go out there in fairy tale land and think, I'm going to get rich. Because every penny of potential profit using leverage is mirrored by a potential loss equal to that amount. Now, leverage, even though you'll see all kinds of brokers out there advertising 1,000 to 1, 500 to 1, leverage is overseen by the regulator, and the regulators set the leverage rate per asset class. So let's say hypothetically you're trading X, Y, and Z, and X, Y, and Z falls in an asset class that has a 50 to 1 leverage ratio. If you have $1,000 in your account, it means you could trade $50,000 worth of X, Y, and Z. Well, if X, Y, and Z was trading at $100 a share, and you could trade $50,000 worth, means you could then trade what? 500 shares. If X, Y, and Z went up $2 that day, guess what? You made $1,000. But if it dropped $1, you would have lost $1,000. So keep that in mind. Leverage allows you to ramp up your position, but it is mirrored by the same loss. And that is why we always want to use risk management tools such as stop losses to make sure if the market moves against you, you don't lose your shirt. Another advantage to CFD trading is it has low costs. Most CFDs are closed within 24 hours. You can leave a CFD open day after day after day, but most are closed within 24 hours. And because of the contract between you and the broker, the costs are minimal. There's no commission, and the cost is known as the spread, and it's very, very low. So your cost for trading becomes much lower. So let's go on and talk about Forex and CFD trading and how it works. Okay. Now, before we begin explaining why Forex trading is so popular, we first have to tell you a bit about trading and the Forex market. As an activity, trading has always been portrayed as a premium occupation that opens up doors to an inevitable lifestyle. Forget that stuff. Forget the stuff you used to see in the 80s and the 90s with some guy laying on the beach with his laptop getting rich. You see a commercial or an advertisement with a guy in front of a Rolls Royce with diamonds hanging around his neck. You know it's a scam. Forex and CFD trading takes a lot of work, takes a lot of effort, and you can be successful. But it's not an overnight get rich quick scheme. And it does take intelligence, it doesn't take education, it takes your experience, and it takes a good comprehension on what you are doing. So why are there millions of people trading Forex and CFDs? Trading instruments range from well-known stocks to blue chip companies to exotic items such as futures on orange juice. So why is the most popular trading market? People trade lots of assets, but the largest turnover is created by the Forex market. Now, most Forex transactions are executed by banks, large multinational trade organizations, hedge funds, private investors. While private investors like you and me, we make up about a 5% of the daily turnover, which is about, I think at last point, it was $7 trillion a day. Now, like I said, a lot of them are banks or multinational trading organizations or hedge funds. But for instance, right out of college, I had a job for Crown Zellerbach, which was one of the biggest lumber manufacturers in the world. And my job was, and this is way before the euro. So we had every currency in every country. And my job was making sure that every country had the amount of necessary currency in their local bank accounts to pay all their bills and their upcoming bills, and to make sure that we were buying that currency in the most advantageous way, because we would have, francs, and we would have Swiss francs, and we would have, I don't even remember what they all were from all those European countries anymore. But maybe one currency was down, the other currency was up, and I would need to have more Swiss francs because we had huge shipments of lumber being bought. Okay. And we just got paid in Belgium or Italy from somebody who bought a huge load of lumber. And it was my job to take that excess cash in Italy and move it into the currencies that we would need to pay our bills at the best price possible. So these are the kinds of transactions that make up the Forex market. But you and I, we're retail traders. We're the little guys. Now, this might sound small to you, but 5% stands for about 250 billion US dollars in daily transactions. Now, it took nearly a decade for the Forex market to become an attractive place for retail traders. And this is mainly due to the development of the most common trading platforms, as well as the dynamic online web platform and the access from the internet. Now, even when I started trading online, we didn't have dynamic charts. We had static charts. We didn't have very fast feeds to the charts. We didn't have extremely fast platforms. We didn't have deep liquidity. We didn't have all the oscillators and indicators unless you did it by hand to stay on top of the markets and compete against all of these other traders out there. Today, whether you're a little guy with $1,000 in an account or the big guy at Crown Zellerbach trading, converting millions of dollars a day, we have the same tools, we have the same feeds, we have the same data, we have the same everything. We can make the trades just as fast. And this is what gave us, the little trader, the edge, because we can see quicker inconsistencies in the markets. Now, many people think about, and you always hear them talk about demand and supply. Supply and demand have very little to do with our type of trading. Okay. If you might be buying $1 million worth of the dollar or $1 million and owning it and sitting on it for a year and hoping it goes up in value, that would have something to do with supply and demand. When we're trading Forex or CFDs, we're looking for small movements in a market. We're looking to see the euro just fell a couple pips just now, and it's probably going to go back up to the point where it was this morning and go back up the couple pips. That's all we don't really care what the euro will be doing in a year from now. We don't even care what the euro should be trading at. We only care where the euro is at the moment and where it might be in a very short period afterwards. So remember, I said to you, advancement in technology is a great feature for Forex trading. And this is what really makes Forex trading so special. Now, even just a couple years ago, the brokers tried to offer everything they could, but they didn't have the technology. They didn't have the charts that you could trade from the charts. They didn't have charts that would have you be able to put all the indicators and oscillators on. Today, everybody has everything at their fingertips. Now, let me pop up a chart that I have ready for you. Okay, we're looking at the current Euro US dollar chart. Okay. Now, we're also looking at it trading from TradingView. Now, because I have a paid for account at TradingView, I get the fastest feeds. The feeds that send in this data. Now, nobody cares about what the data was a half hour ago, last week, last month, last year. That's all over and done with, and it's just written in stone. Okay? Anybody can let you go back and look at the past. So whether you're trading currencies, whether you're trading stocks, it is all dependent on the data feed and the most current data, because you need to be getting it as fast as the big banks and the big brokers. So a lot of people don't want to trade or think that they can trade on free accounts. Okay. Or they want to use a different charting service. Now, your broker, especially Alvexo, uses the fastest, most up-to-date data feeds possible. Okay. Well, why is that? Well, first of all, they're already paying for those data feeds because they have to give you the constant prices of those assets for you to buy and sell. But that's the same data feed that feeds the charts. Now, remember, there's thousands and thousands and thousands of assets out there, and there's hundreds of exchanges and hundreds of suppliers. Data costs a huge amount of money. So keep that in mind. Data isn't free. It's not a matter of somebody writing just some technology and getting into your charts. Somebody has to pay for that data. So keep that in mind, because the only thing that's ultimately important to you as a trader is here. You can only trade going forward. You can only rely on this data. The rest of it is just historic data. It's already happened. It's the same on every single chart in the world. The open, the close, the high and the low for last Monday, or for 6 hours ago, or for last Thursday is always the same. Once it's happened, it's written in stone and can't be changed. So keep that in mind. It's one of the important things that a trader has to understand when they're entering this type of marketplace. Most traders don't think about anything. They just go up there and they think that they got everything. Okay. They don't understand what the difference is and why they need to use this technology. Now, let's talk about the risk involved. What you do have to keep in mind is that Forex involves a high degree of risk. Like any other trading, or perhaps even higher, Forex trading is carried out on a margin basis. Forex is quite a volatile market, and due to these factors, even a relatively small price fluctuation can lead to substantial profits or losses. This is why Forex is so risky, especially when a trader tries to achieve too optimistic results within a short period of time. You should understand the risk before you start to trade. So in other words, if we look at the euro US dollar, and this is a 30-minute chart, that is the current chart, and we see, oh, the euro US dollar has been trading up, 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 up. Well, my line's not so straight. Hold on, let me clean this up. Okay, and we see the euro drop down. Now, I'm not advising on a trade. I'm just telling you hypothetically. And you say, well, I think it's going to continue up. It's just doing a retracement here. So I'm going to buy the euro. Okay, you decide to buy it here at this level of resistance. You've got to decide where you're going to put your stop loss. Where are you going to maximize where are you going to, what the risk is that you would have. Because you can't just say, I'll put my stop loss here, and if it moves against me, I'll just close it out. Because the bounce of the market will probably bounce it down below there, and you'll get stopped out, and you'll end up closing a losing trade, a winning trade, but you never got to stay in and win. So you have to be able to determine, where can I set my stop loss that I won't get shut out of the markets before it makes its move, but also what can I afford to lose? Because from here to here is a lot of pips. And if you're using margin or leverage, this could be thousands of dollars. So you have to understand where you would put your stop loss, where you'd want to exit the market compared to what potential profit you have. But where you'd want to get out of that market if the market doesn't move in your favor is very important, because Forex trading, CFD trading, is more about minimizing your losses and maximizing your profits. Because even though I've been trading since the 70s, I'm still very lucky, if I work really hard and concentrate, that I trade at much more than a 54% success rate. And that's pretty good. But at that 54% rate makes high profit on those trades, and the 46% that I lose, I close out with minimum losses. Ultimately, my profits outweigh my losses, so my net at the end of a day or week or a month is profit, and that's what it's all about. So keep that in mind at all times. Now, most brokers, including Alvexo, offer demo trading platforms. Okay, now, a demo platform is a great help. It's not for you to play on. It simulates the real world activity, but a whole idea of a demo platform is you keep it going while you have a live platform. And it's where you test your thoughts. It's where you develop your strategies. It's where you test everything. Okay? Because, let's explain this to you in an easy to understand example. Somebody once told me, most traders spend most of the time sitting on the sidelines. When you're sitting on the sidelines, you're just an observer. So you're at a football game, and you're out there screaming at the ref. You're out there screaming at your players. They're making stupid mistakes. You're screaming at them, but you're not in the game. You're sitting on the sidelines. You can sell all you want. But when you go down on the field and somebody says, get out there and play, guess what? You can't just yell them from those sidelines anymore. You've got to deliver. But when you go out to play, you've entered risk. You can get hurt. You can make stupid plays. You could be booed off the field. But you've just taken on a huge amount of risk. You don't make any profit until you close that trade. So until that last minute whistle's blown and that game is over, you have no profit in your account. So it's important that you learn from that practice. You learn from those scrimmages. You test out every play. Now, In the Forex market, there are several fundamental terms you need to be aware of that may be different than if you traded stocks or futures, though some terms may be the same. If you have traded anything before, the fundamentals of trading currencies are basically the same. You exchange one item for another of value. A lot of people get this confused. If you're trading the euro dollar, you're trading euros against the dollars. You are simultaneously, when you open a contract, you are buying one asset and selling the other. So in other words, if you've ever gone on vacation before and you've gone to the commission store to trade in your money, you go there and say you're going to Australia and you got pounds. It says we'll buy the pound at one price, we'll sell the pound to you at a different price. Okay. Because if you're going to Australia, you've got pounds in your hand. You're selling those pounds to the commission broker and you're buying Australian dollars. And he's going to give you that value today. Now, when you come back from Australia, you've got more Australian dollars left. You go back to the commission broker. What are you doing now? You're selling those Australian dollars you have in your hand and buying back the pound. If the pound fell while you were on vacation, so those Australian dollars are more valuable, you end up with more pounds than you actually bought to begin with. So it's constantly one currency against the other. It's the value of one against the other. Okay. So in other words, if you're trading the euro US dollar and you think the euro is going to go up, so it's going to climb against the dollar, well, say for some reason the euro doesn't go up today, but the dollar falls, you still come out ahead because it's just the value of one compared to the other. It's just like if you buy a share of Microsoft. When you're actually buying that share of Microsoft, you're buying that share of Microsoft against the US dollar. Because Microsoft is selling for, say, $429 a share. Well, that's at the basis of what the dollar is right now. But if you're in London and you want to buy those shares of Microsoft, you're still buying against the dollar, but you have to trade in the equal amount of the value of the pound against the dollar to get those shares of Microsoft. So all currencies in the Forex market are quoted in pairs: euro, US dollar, Japanese yen. Now, this is important. The first listed currency is known as the base or the transactional currency, while the second is called the quote or the counter quote. So even though this is in Forex, if you're buying gold, guess what? You're buying gold in US dollars. So the currency pair is used to depict how much quote currency is required to exchange for the base currency. For example, if the euro US dollar was trading at 135, would mean that every 1 euro has the same value of $1.35. So in other words, if you want 1 euro, you got to give the commission guy $1.35. Now, although the currencies are quoted in pairs, the pairs itself can be regarded as a single unit with the base currency as the basis of the transactions. For example, if you buy the euro US dollar, you will be buying euros and selling US dollars. All Forex quotes are quoted with a two-way price, and that's called the bid and the ask. And this is very important because when you're trading CFDs, you have to understand the bid and the ask price, because you're buying, you're paying one price. If you're selling others, you could open a contract and close it seconds later. And guess what? You would have still lost money because you bought at the bid and sold at the ask. Now, the difference between the bid and the ask is also considered called the spread. It's what the broker makes. Like I said, when you go to the commission store, he's quoting, he'll buy the euro at one price, sell the euro at another price. The difference between those two prices is the spread. It's a very small amount, but you have to be aware of it, because when you buy a currency pair or you buy an asset or CFD, you'll see the buy price or the sell price. You have to be aware of what you're doing. Are you buying gold or are you selling gold? The ask, also known as the offer price, is the price that the dealer will sell the base currency for in the example. The spread is the difference between the ask price and the big price. Or say 3 pips in this example. You bought at 130, they were willing to buy at 132.38, willing to sell at 132.35. Now 3 pips is a minuscule amount of money. And even with leverage, it's still a minuscule amount of money. Now Forex, and today, well, Forex is traded in what we call pips, percentage and point. We more explain it as 4 decimals to the right, because when you're talking about the euro US dollar and you're talking about, let's see what it's trading for right now. Hold on a second, let's pop up a live chart. So when you look over here on the right hand side, you see the euro is trading at 109.804. All those distances, and that far right distance is a pip. It's a small, a thousandth of a cent. But you have to be aware of it, because if you got $100,000 leveraged, that 1 pip, which is 1,000 of a cent, could be equal to a sizable amount of dollars. So most people don't ever use, I don't think I've ever said percentage of point, and most people just think of the pip as the decimal points to the right. Technically, a pip in a share today, if you're buying the, say Alphabet at 125.35, a pip would be the 2 decimals to the right, or it would be a penny. So we kind of know what it is automatically. Since traders deposit their funds in several different currencies globally, the value of a pip, which would link directly to your profit and loss, may need to be converted back to whatever you have in your account. Now, this is where it gets a little bit confusing. If you open an account in London and you deposit pounds, but you're trading euro US dollar, how does that relate to the pound? Well, it really doesn't. The euro US dollar goes up, the euro US dollar goes down. You get your favor, but it's deposited back in your account for the value of those pounds. Now, margin, we've talked about, is an important thing to understand. Margin is the amount of money needed to open and maintain an open position. Think of it as the collateral given to a financial institution to ensure you have adequate equity to cover your position. So in other words, if you wanted to trade $10,000 worth of X, Y, and Z stock, and X, Y, and Z was selling for $100, you would get 1,000 shares. But you only have so much money in your account. Okay. The deposit that's required, which would be, say, 20% on your $10,000 trade, would be $2,000. That's your margin. It's a down payment. It's not a fee. It's not a cost. It's just how much you have to have in your account to make that trade. So margin is related to leverage, as you need collateral in order to control a position larger than you have. So for instance, if you were with a broker that offered a leverage of 50 to 1 and you had $1,000 in your account, you would have a maximum buying power of $50,000. In other words, $1,000 times 50, instead of just $1,000 you have in your account. But be aware that margin and leverage ramp up your trading and profits, but they do the same in reverse. They increase your risk and your potential losses. So please understand these risks before you make a trade. Now, also a very important thing, it is critically important. And most traders, I would say 95% of the people I teach, and I go back to ask them, they don't know the difference between one order and another order. The types of orders are critically important, because you can actually use different order types to make profit. And using the right order type can make you a lot of money. So the common and most frequently used one is called a market order. It's just an unrestricted order. It's when you go into the Alvexo, say I want to buy this, you fill out the ticket, and it's going to buy that asset at the quoted price or the best price possible at the moment you click trade. Okay. When you want to exit the market, it's going to exit when you click close your position at the most advantageous price at that second. In other words, a market order tells the computer to execute your trades at the moment as close to the price possible. Doesn't guarantee you'll get the price, but it'll be pretty close. But then we have incredible things like limit order. A limit order is an order placed with a broker to buy or sell a set number of shares or a set number of currencies at a specified price or better. Now, say for instance, you were looking at X, Y, and Z stock. It was trading at $100. You thought it would go up to 125 today, but you notice when it hits 100, it may fall down to 97. It goes back up to 100, goes down to 98, goes back up to 100, falls down to 96. Then finally, it'll break above the 100 and go up. Well, you tell the computer, I'll buy it at 97.50. That means the minute it dips down to 97.50, it'll execute your trade instead of executing it as a market order right when you said at $100. Well, now you entered that same trade 10 minutes later, but you entered it at 97.50 instead of $100. Same thing when selling. Now, a stop order is probably the most critical order you can place. When you open a ticket to trade, it's going to ask you if you want to place a stop order. Stop order tells the computer to close your position if the market hits a specific price lower or higher, the opposite direction of your current position. So in other words, if X, Y, and Z was selling at $100, you told the computer to buy it for you at 97.50. But you could also tell the computer, close my position after it's executed if it ever falls below 96. And if it falls below 96, it's going to close out your position. Okay, it's to protect you against some loss in the marketplace. Then we also have trailing stop losses. Now, trailing stop losses, but I use all the time. A trailing stop order is an order that trails the predetermined percentage level or pip level from the market price. So in other words, if I go to and open a trade, it's $100 in X, Y, and Z, tell the computer to enter that trade with a limit order at 97.50. I could tell the computer to give me a trailing stop loss at $1.50 below the opening price. So in other words, the computer would close my position at 96. But if that stock shoots up to 105, my trailing stop loss will move up and say $1.50 below that price. So my trailing stop loss would move up to 103.50. If the market dipped back down, it would close my trade at 103.50. Now you have to keep in mind, the market might dip down to 103.50 and it's sort of 120. But if it dips down to 103.50, it's going to close your position, but you would have closed your position in profit. Now, stop orders and trailing stop orders can be changed constantly. You can change the percentage level, the pip level. If you're monitoring the market, you could do anything you want to do. Then we also have orders like OCO. One cancels the other. Great order, great way to make trades. If you're not sure a stock's going to go up or down or an asset's going to go up or down, say, again, you're looking at X, Y, and Z, and you're waiting for it to break 100 to go to 125. But you know if it hits the 100, it doesn't go up and it falls down to 97.50, it should turn around then. But if it goes to 96, it's going to start tumbling. Something happened, or something you were waiting to happen didn't happen. Well, you can tell the computer to open you a trade if the market hits 97.50 and buy, or to sell a position if it hits 96. And what it'll do is one order will cancel the order. Whichever one happens first, the market will cancel the other one. Okay. Then you have GDC, good to close. For instance, you thought X, Y, and Z was going to go up to above 100 today, but you told the computer to open at 97.50. Okay. Never hit 97.50 today. Your position didn't get open. But if you did a GTC, you don't have to worry about it when you're asleep. When the market closes for that day, it cancels your order and goes away. But say you want to buy X, Y, and Z, you want to accumulate X, Y, and Z. Well, you know, every time X, Y, and Z hits 97.50, it soars up to above 100. You can set up a trade and tell it's good for the day. It'll stay open all day long. Now, we have all heard about to each their own, where any person has a taste or style that may be completely different than another's. And why, with so many market participants, the Forex market, CFD market, so many different objectives that couldn't be truer. So if your quest is becoming a long-term successful trader, you'll need to figure out which of these, or perhaps the combination of trading styles, suits the best based for how much time you have to devote each day, your risk tolerance, and your interest levels. You could be a day trader, or I don't call it day trader, I call it short-term trader. CFDs, like I said, most are closed within 24 hours, but a day trader doesn't really exist anymore. They're short-term traders because the CFD can open and close as often as you want. Swing trading is also an interesting way to trade. Doesn't require as much tension, and it could be an easy way to get into the market. Position trading is another way. Position traders are much longer term trades who hold for positions longer. But always keep in mind risk, risk, risk. So many traders come with the misguided hope of making tons of money, but long-term trading success has been limited to a very small percentage of traders. Most retail traders lose money. In fact, it's probably around 95%, and that's no typo. So if you're thinking you're better than those 95%, you're just doing them as your ego is clearly in charge here, and your ego has no place in long-term successful trading. It's not a get-rich-quick scheme. It's a slow, steady process of improving your skill, limiting your losses and your risk, and making profits. So on that note, I'm going to say goodnight to everybody. Thank you for joining us. And if you want to learn more, come to one of our advanced courses on technical analysis, reading charts, or how to trade. And we'll make sure you have the best education possible. And thank you for being part of the Eldexo family. Good night now.